actually become energy dependent again.
We have been enjoying some nice, low gasoline prices. How quickly are these higher oil prices going to mean higher prices at the pump?
Yeah, it's going to be very quickly. And like a lot of Americans are probably very aware of oil futures, there are also spot markets, right? Oil prices don't wait to react. That oil delivery that's on the water is reassessed. Whatever happens globally, it's a very tight economy, a very global economy. And so those spot prices are going up alongside futures. So keep in mind, this isn't just something that's going to wait for a month until the April contract. This is something that's going to impact gas prices probably starting today. The national average will start to tick higher. We could see gas prices by around lunch or even in the evening start to go up as gas stations are probably getting alerts themselves of a big jump in the price that they pay. Oil up 7 to 8%. The wholesale price of gasoline up over 10 cents a gallon. So like I said, this probably won't be a spike, but it's going to be noticeable, and it comes on the heels of seasonal increases in gas prices as most of the nation has already begun the transition to cleaner, more expensive blends of summer gasoline. The seasonality along with the attacks on Iran is surely going to lead most motorists to see higher gas prices here, not just over the next few days, but really the next several weeks, if not 2 or 3 months.
These energy companies are watching everything that's happening, and they're having to reassess all of their supply chains. Even if they're domestic focused, what happens abroad is still going to ripple through. The oil market is oversupplied right now, but a lot of that oversupply is stuck behind the Strait of Hormuz, stuck behind some of these choke points. What's going to be really important to watch here is how much this risk premium moves, because it's going to tell you a little bit about where gasoline prices are going to go. On Friday night, the risk premium above what analysts call the fair value of oil was at about $7. Right now, it's around 18. That's a historical extreme high. Gas companies who are running those pumps that you and I drive up to every few days are looking at this and assessing a tighter market, assessing barrels being taken off supply, coming off the market for at least probably the next few days to weeks as this conflict resolves or does not. It could get even longer than that.
So we talked about the transmission of higher oil prices to prices at the pump, which is very quick. What about on the flip side? When prices start to come down, does my gas station right away say, okay, I'm going to lower the price? Or do they try and hold on to that price increase as long as they can?
Yeah, it works both ways. Stations will start lowering prices as their cost comes down, but here's why it takes a little bit longer for prices to go down. Stations right now, because of competition, only about a third of U.S. gas stations are buying gasoline today, maybe more like a quarter of them. In fact, few of them are probably filling up their tanks today, but they aren't able to fully pass along the increase in price because their competitors may not be filling up today. Their price may be lower. So the competition may not yet be raising prices, and that's going to limit how quickly stations can readjust their prices or how much they can raise their price, because they know consumers aren't going to pay 15 cents a gallon more if the competition down the street does not have that more expensive gasoline yet. So stations are probably going to take it on the chin for the next few days, unable to fully pass along the increase. And that's why when prices do eventually go down, they'll try to make up for that time. That is, stations will pass along the decreases, but slower than the market declines, because they also took it on the chin when prices go up. And instead of having all sorts of crazy prices different across town, depending on if a station is buying at the higher price or not, it tends to even out. Competition moves slowly upward, and it will also move slowly downward.
What would be the effect on prices at the pump if there was $100 a barrel oil?
Yeah, I mean, if we're talking about $100 Brent, we'd be talking about, I believe, another $20 a barrel or so. Brent crude oil, as I look right now, at about $78 a barrel. So that would be a pretty noticeable uptick. We'd be talking about gas prices probably in the mid to upper $3 a gallon range, maybe not $4 a gallon. But that's where we stand now. And keep in mind, I said the seasonal trends, refinery maintenance is happening. And I don't want consumers to get confused here. There's a lot of things that can happen concurrently to the price of gasoline to have impacts. And if prices were to spike in, say, a week, it may not necessarily be the Iran portion of that Refineries are doing maintenance. If any unexpected issues arise, that could also cause a spike. But ultimately, as long as this situation's unfolding, as long as the risk is elevated, especially as was mentioned through the Strait of Hormuz, we're going to see oil prices probably impacted for a couple weeks. And the president made very clear this is not going to be a very short attack on Iran. This may be drawn out, and we don't know if that means at least several days or several weeks, but it seems like this may be a longer situation than the 12-day war that we saw earlier.
Jake, I want to ask about about what we have seen traditionally from the oil companies here in the U.S. as well, the big exploration and production companies. When price goes up, does production follow?
It used to be a bit more of a one-to-one relationship. It really is not anymore. You look at some of the feedback the Dallas Fed got on its latest energy survey. People are saying prices in the patch, prices out in the oil field are going only up. Crews are getting more expensive. Maintenance is getting more expensive. Rigs are getting more expensive. All of that is going to weigh on these companies that are trying to assess, do we drill? Do we pull back? Do we focus on share buybacks and dividends? How do we assess risk? The interesting thing is that right now, a lot of these big energy companies are looking at their reserve rates, kind of the rate that they're replacing barrels, and saying, we are at a point where we need to start drilling more. We need to get those reserve rates back up because of the last 5 to 10 years, the industry really shifted toward cash maintenance, dividend payments, steady accumulation.
Right.
Now, they've got to start taking more risks. This is, of course, going to make drilling more attractive if oil prices stay elevated. But to the points we've been making all morning, it's really unclear where this is going to go. And if I'm the CEO of a major energy company, I'm not going to want to jump and start spending the money to drill until I've got a much better idea of where this conflict is going and where prices are going.
Yeah, it comes back to the duration question. And Patrick, are there any levers that the U.S. administration can pull at this point to bring prices down if they really start to spike up?
Yeah, Julie. Well, we've seen that lever being utilized already by the Biden administration. That is the Strategic Petroleum Reserve. Now, there's a lot of very, very strong feelings on how Biden used them. Trump could also utilize them. And keep in mind that 410 million or 412 million barrel Strategic Petroleum Reserve remains half full. It's been slowly going up for several years. And suddenly, with oil prices spiking 7%, we're talking an increase in billions of dollars, how much that oil is worth. So yes, the president could release oil from the SPR. As an analyst, we go through if this is really warranted. Oil prices in the mid-70s. It's not really warranted yet, but it is something that he could do. We've also seen the administration waiving CAFE standards. They could ease the summer gasoline standards. So not only could they push oil lower by releasing oil from the SPR, but they could temporarily waive summer gasoline requirements, which could make it easier for refineries to produce those blends.